welcome to the weekly mortgage market update for the week of August 14th, 2017. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, last week was definitely good for mortgage rates. They're able to move lower almost to the lows of 2017. Take a look at the bond chart on the screen. You can see the upward channel now is again for mortgage bonds to move higher with that arrow. They've moved all the way up, almost touching the highs of 2017. And remember, as mortgage bonds move up, mortgage interest rates move down. So bond prices going up is good for lower interest rates. So you can see that we touched that 2017 high. We did move down from that, but we were able to close on Friday above a level of support, which has held all 3 days. So with the momentum for mortgage bonds to move higher, making a run on the 2017 highs, and with mortgage bonds closing above support on Friday, we're going to recommend floating your mortgage rate to start the week to see if we can move to the lows of the year. So go ahead and float. Now, if we dig into the economic news, two big things that help mortgage rates resume their upward, mortgage bonds resume their upward move and rates to move lower. First was the tensions between the United States and North Korea were heightened as the two world leaders exchanged barbs about what they would do to each other. So that kind of escalated the tension there. Uncertainty is bad for stocks, so stocks sold off. Move the money into the bond market. Anytime money moves into the bond market, it drives the price higher. So as the mortgage bond prices moved up, mortgage interest rates moved down. So we benefited from the heightened tension. And the second thing that helped mortgage bonds also rally higher was inflation is the enemy of bonds. We've got two reports this week on inflation. The first one was the producer price index for July 2017. Came in very tame. We had basically only it dropped 0.1% from June. Expectations for it to increase by 0.2% would actually drop 0.1%. In the core producer price index year over year was only 1.9%. That's still below the Fed's target of 2%. Now the Fed's really looking at consumer inflation. So the report there was the consumer price index, or CPI, for July 2017, which was only 1.7% year over year, well below the 2% Fed target market for consumer inflation. The core CPI has been declining since February 2017. So that low inflation, that's good news for bonds. We're going to see mortgage rates benefit from that. So that's why we'll recommend the floating with the low inflation to see if we can make a run for the lowest rates we've seen in 2017. Then we saw weak initial jobless claims come out on Thursday. Claims moved up slightly, 3,000 claims to 244,000 claims for the week. That's the 127th consecutive week of jobless claims below 300,000 claims. That's a huge streak. That shows very strong labor market in terms of jobless claims. People that want to work are finding a work. They're not out there filing initial jobless claims. So we do have a hot labor market, which is good news. Unemployment rate we saw in the last jobs report ticked down to 4.3%. That's the lowest since March 2001. So overall, on the labor front, very good news, very strong labor market, which translated into helping the housing market. Now in housing news, CoreLogic released their loan performance insights for May 2017, which shows loans that are 30 days or more past due or delinquent dropped from 4.8% April to only 4.5% in May. And that's down from 5.3% in May of 2016. And the number of homes in foreclosure remained the same as April at 0.7% of all homes. But that's down from 1% in May of 2016. So as home prices rise, the national delinquency rate goes down because there's equity in the property. People can sell them and just get out of them if they're upside down. They're no longer upside down. I mean, they can get out of them now if they're behind on the mortgages. So that's great news on housing. It's a great time to buy. We expect home prices to continue going up. So now's the time to buy. Don't wait. The longer you wait, the more you're going to pay for the price of the home. It's a seller's market. You've got to come in there and go in high. If the price is $200,000 and it's priced right and you offer $190,000, you're probably not getting the house. It's definitely a seller's market. And if you wait 3 months, that $200,000 house might be $203,000, $205,000 because the market is hot. It's moving up. Now in the local news, the next first-time homebuyer seminar is this Saturday, August 19th from 10 a.m. to noon in Newark, Delaware at the Christiana Hilton Hotel. And then the next one in Dover is Saturday, September 16th from 10 a.m. to noon at the Dover Holiday Inn in Dover, Delaware. You can register for either one of those events by just calling the office at 302-703-0727 or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.